Welcome everyone. Today we'll explore two popular investment vehicles that many investors consider exchange-traded funds, commonly known as ETFs, and mutual funds. We'll delve into their definitions, characteristics, advantages, and disadvantages to help you understand which might be the right choice for your investment strategy. Let's start with definitions. An ETF is a type of investment fund that trades on stock exchanges, much like individual stocks. It typically holds a collection of assets such as stocks, bonds, or commodities, and its price fluctuates throughout the trading day. For example, a popular ETF might track the S&P 500, allowing investors to gain exposure to a broad range of U.S. companies. In contrast, a mutual fund is an investment program funded by shareholders that trades in diversified holdings and is professionally managed. When you invest in a mutual fund, you buy shares of the fund, and the fund manager invests that money in various assets. For instance, a mutual fund might focus on growth stocks or emerging markets. Now, let's talk about trading and liquidity. ETFs can be bought and sold throughout the day on the stock exchange, meaning you can react quickly to market changes. The ability to trade ETFs like stocks gives them a level of liquidity that many investors appreciate. For example, if you want to take advantage of a market dip, you can buy an ETF immediately. Conversely, mutual funds are traded once a day after the market closes. Investors buy or sell shares at the net asset value, or NAV, determined at the end of the trading day. This means you won't know the exact price you'll get when you place your order until the market closes. Next, we'll compare expenses and fees. Generally, ETFs tend to have lower expense ratios compared to mutual funds. This is mainly because most ETFs are passively managed, tracking an index, which requires less active management. For example, an S&P 500 ETF might have an expense ratio of around 0.03%, while an actively managed mutual fund could charge 1% or more. Mutual funds, especially actively managed ones, can have higher fees due to the management teams involved in selecting the investments. Additionally, some mutual funds impose sales loads or redemption fees, which can further increase your costs. It's important to read the fund's prospectus to understand all fees involved. Let's consider tax efficiency. ETFs usually have a tax advantage over mutual funds due to their unique structure, which allows for in-kind transfers of securities. This minimizes capital gains distributions, making ETFs more tax efficient for investors. For instance, if an investor holds an ETF for several years, they may not incur capital gains taxes until they sell. In contrast, mutual funds often distribute capital gains to shareholders, which can lead to a tax liability even if you haven't sold any shares. This is an important factor to keep in mind, especially for taxable investment accounts. For example, if a mutual fund has a significant capital gain distribution, you could end up paying taxes on profits you didn't realize. Now let's look at investment strategies. ETFs are often favored by investors looking for specific sector exposure or a passive investment strategy. With the wide range of ETFs available, you can easily diversify across different sectors, regions, or asset classes. For instance, if you believe renewable energy is the future, you can invest in an ETF that specifically tracks renewable energy companies. Mutual funds, especially actively managed ones, are appealing to investors who prefer a hands-off approach, trusting professionals to manage their investments. Some investors believe that active management can outperform the market over the long term, although this is a topic of debate among experts. Many studies suggest that only a small percentage of active managers consistently beat their benchmarks. Another factor to consider is the minimum investment required. Many mutual funds have minimum investment thresholds which can range from a few hundred to several $1,000s. This can be a barrier for new investors, especially young or novice investors who want to start small. In contrast, ETFs can be purchased in any quantity, as long as you can afford the price of one share. This makes ETFs more accessible for investors who want to start with a smaller investment. For example, if an ETF is priced at $50 per share, you can invest $50 or more. Let's also touch on dividend reinvestment. Many mutual funds offer automatic reinvestment of dividends, allowing investors to buy more shares without incurring additional fees. This can be a great way to grow your investment over time. For instance, if a mutual fund pays a $1 dividend, that amount can be reinvested to purchase more shares, compounding your investment. ETFs may also offer dividend reinvestment options, but it depends on the brokerage. Some brokerages provide automatic reinvestment plans, while others may require investors to manually reinvest dividends. Let's discuss performance tracking. Investors often seek transparency and understand how their investments are performing. ETFs typically have their performance linked directly to the index they track, making it easier to evaluate how well they are doing relative to the market. In contrast, mutual fund performance can be more challenging to gauge. Since mutual funds can be actively managed, their performance can vary significantly from year to year. Additionally, it's essential to evaluate a fund's performance over different market cycles to get a complete picture. Next, let's talk about market volatility. ETFs can be more sensitive to market fluctuations because they trade on exchanges like stocks. During periods of high volatility, the price of an ETF can deviate from its underlying asset value. This can lead to buying or selling at unfavorable prices if investors react impulsively to market changes. Conversely, mutual funds are not affected by intraday price changes. Their value is only determined once at the end of the trading day, which can provide a more stable experience for some investors. This might help prevent emotional reactions to market volatility. In conclusion, both ETFs and mutual funds have their strengths and weaknesses. ETFs offer liquidity, lower expenses, and tax efficiency, making them suitable for active traders and cost-conscious investors. On the other hand, mutual funds provide professional management and are ideal for investors who prefer a more hands-off approach. When deciding between the two, it's essential to consider your investment goals, risk tolerance, and investment strategy. Understanding the key differences will help you make informed choices that align with your financial objectives. Thank you for joining us today as we explored ETFs and mutual funds. Happy investing! Make sure to subscribe and like the video before leaving.